Right now, something unusual is happening deep inside the infrastructure of the global gold market. Quietly, without headlines or public panic, COMEX vaults have just lost more than 1 million ounces of gold in a single week, pushing registered inventories toward levels that traders haven't seen in years. At the same time, gold prices are hovering near $5,200 per ounce. ETF inflows are accelerating again, and large institutional buyers appear to be pulling physical metal out of the system faster than it is being replaced. Now, on the surface, a vault withdrawal might sound like a routine movement of bullion, but in the highly leveraged structure of modern commodities markets, these kinds of physical withdrawals can carry enormous implications. The reason is simple: the global gold market trades enormous volumes of paper gold contracts every day, often representing hundreds of ounces for every single ounce sitting in a vault. As long as only a small percentage of traders ask for delivery, the system works smoothly. But if physical demand rises while inventories fall, the balance between paper contracts and real metal can begin to tighten. And historically, when that balance tightens, markets can become extremely volatile. What begins as a quiet shift in inventories can quickly transform into a major market story involving price spikes, delivery stress, and sudden institutional repositioning. Today we're going to break down exactly what is happening inside the COMEX vault system, why physical gold inventories are shrinking so rapidly, and whether this could signal the early stages of a tightening supply environment that investors around the world should be watching very closely. At first glance, changes in gold vault inventories might seem like a niche issue that only matters to commodities traders or hedge funds. But the reality is that the gold market sits at the center of the global financial system in ways that most people rarely think about. Gold has historically functioned as a monetary asset, a reserve currency alternative, and a financial safety valve during periods of economic stress. Central banks hold thousands of tons of gold as part of their national reserves precisely because it represents something very rare in modern finance, an asset that carries no counterparty risk. When pressure begins to build inside the gold market, it can signal deeper issues happening beneath the surface of the global economy. Investors turn to gold when they are worried about inflation, currency instability, banking stress, or geopolitical risk. Businesses watch gold prices because they influence the cost of financing, investment flows, and currency strength. Even pension funds and sovereign wealth funds allocate billions of dollars to gold when they want protection against systemic shocks. That means when inventories in the physical gold market begin shrinking while prices remain elevated, it raises an important question: why are large buyers suddenly pulling metal out of the system? If the trend continues, it could affect everything from exchange-traded funds to currency markets to institutional portfolio strategies. In other words, what looks like a quiet movement of bullion bars inside a vault can actually reflect a much larger shift in global financial confidence. And when confidence shifts, the ripple effects can move through markets far faster than most people expect. The immediate trigger for the current conversation about a possible gold squeeze is the latest data from the COMEX Vault reporting system. Over the past week, official reports showed that vault inventories dropped by approximately 1 million ounces of gold, one of the most notable weekly declines seen in recent months. More importantly, the decline is occurring in the category known as registered gold, which represents the portion of metal that is actually available to settle futures contracts. COMEX vaults typically store gold in two classifications: eligible and registered. Eligible gold meets the exchange's purity and bar size requirements, but belongs to private owners who are not necessarily offering it for delivery. Registered gold, however, is specifically designated for fulfilling futures contracts if traders request physical settlement. When registered inventory begins falling rapidly, traders start asking a simple question: how much metal is actually available if delivery demand increases? At the same time these withdrawals were occurring, gold prices remain near historic highs around $5,200, suggesting that demand for bullion remains strong even at elevated price levels. In addition, gold-backed ETFs have begun reporting renewed inflows after months of mixed investor sentiment. That combination, rising institutional demand, strong prices, and shrinking deliverable inventories, creates a dynamic that market analysts watch very carefully. While the system still holds significant total gold inventory, the key concern is the rate of change. If withdrawals continue faster than new supply enters the vault system, the cushion between paper trading volume and physical metal availability becomes progressively smaller. To understand the deeper cause behind these developments, it's important to look at how the gold market actually functions on a structural level. Unlike most consumer goods markets, the majority of of gold trading does not involve physical bars changing hands. Instead, the dominant mechanism is the futures market, where traders buy and sell contracts representing future delivery of gold. These contracts allow hedge funds, banks, mining companies, and asset managers to hedge risk or speculate on price movements without needing to store physical bullion. Because of this system, the amount of gold represented by futures contracts can be dramatically larger than the actual metal sitting inside vaults. In many cases, the ratio between paper gold trading and physical inventory can reach dozens or even hundreds of contracts per ounce of registered metal. This structure works efficiently under normal conditions because most futures traders close their positions before delivery occurs. However, when physical demand rises, whether from institutional investors, central banks, or private buyers, the balance between contracts and deliverable supply begins to tighten. If more traders decide to stand for delivery rather than settle contracts financially, the exchange must rely on the registered metal held in vaults. When that pool begins shrinking while demand remains strong, markets can start adjusting prices to attract new supply. In other words, the falling inventory may not be the cause of the price move, it may be the signal that underlying physical demand is already increasing. When precious metals markets experience extreme volatility or supply stress, the consequences can ripple far beyond commodity traders. Businesses that depend on stable metal pricing, such as electronics manufacturers, jewelry producers, and industrial supply chains, can suddenly face dramatic cost swings. Gold is used in everything from semiconductor manufacturing to high-end electronics, aerospace components, and advanced medical equipment. If supply tightens or prices move rapidly, companies may be forced to adjust production costs, renegotiate contracts, or absorb unexpected losses. Financial institutions also face significant exposure. Banks that act as market makers in metals markets often carry complex derivative positions designed to hedge price risk. In periods of rapid price movement or tightening liquidity, those positions can become difficult to manage. Hedge funds and leveraged traders may experience margin pressure if prices move sharply against their positions, triggering forced liquidations that amplify volatility even further. History shows that commodity squeezes rarely remain isolated within a single market. Instead, they tend to spread through interconnected financial systems, affecting currencies, bond markets, and investor sentiment. For everyday investors, the impact may appear indirectly through rising inflation expectations, changes in asset allocations, or increased financial market volatility. In extreme cases, supply shocks in key commodities can even contribute to broader economic disruptions, as industries struggle to adapt to rapidly shifting input costs. One of the factors that could amplify the current situation is the continued accumulation of gold by central banks around the world. Over the past several years, central bank purchases have reached levels not seen in decades. Countries including China, India, Turkey, and several Middle Eastern economies have been steadily increasing their gold reserves as part of broader efforts to diversify away from traditional reserve assets such as US Treasury bonds. This trend reflects a deeper shift in the global financial system. As geopolitical tensions rise and economic alliances evolve, many governments are looking for ways to reduce their exposure to foreign currency risk. Gold, with its long history as a neutral monetary asset, has become an attractive option. Central bank purchases differ significantly from typical investor demand because they often represent long-term strategic accumulation rather than short-term trading. Once central banks add gold to their reserves, that metal rarely returns to the open market. As a result, sustained central bank buying effectively removes large quantities of gold from circulating supply over time. If this trend continues while investment demand also rises, the combined pressure could tighten the global supply balance even further. In other words, falling COMEX inventories may not simply reflect short-term market movements. They could also be part of a broader pattern of long-term physical accumulation happening across the global financial system. Another factor contributing to the tightening gold market is the growing divergence between Western financial markets and physical demand coming from Asia. Over the past decade, major gold trading hubs such as Shanghai and Singapore have steadily expanded their role in the global bullion market. Asian investors often approach gold differently from Western financial traders. While futures markets in New York and London focus heavily on derivatives and short-term price movements, Asian markets tend to emphasize physical ownership of bullion. Retail investors, banks, and institutional buyers frequently purchase gold bars and store them for long-term savings or wealth preservation. When demand from these regions increases, physical metal can begin flowing eastward from Western vault systems. This shift has already been observed during several periods of strong Asian demand, when bullion shipments moved rapidly from London and New York into Asian markets. If that pattern continues, the declining inventories seen in COMEX vaults may reflect a broader rebalancing of where physical gold is being stored around the world. The implication is significant. While Western futures markets may continue trading enormous volumes of contracts, the actual physical metal underpinning those markets could gradually migrate to regions where long-term holders are less likely to sell it back. When gold markets tighten, the implications can extend far beyond the commodity itself. Governments pay close attention to gold prices because they often reflect underlying confidence in national currencies and financial stability. If gold prices rise rapidly while physical inventories decline, it may indicate that investors are seeking protection against inflation, currency depreciation, or systemic financial risk. Rising gold demand can also influence foreign exchange markets, as countries with strong gold reserves may gain greater financial flexibility during periods of economic stress. For nations that rely heavily on imported commodities, higher gold prices can sometimes signal broader inflation pressures affecting energy, metals, and agricultural products. In addition, sovereign wealth funds and national pension systems frequently allocate capital to gold as part of diversified investment strategies. That means shifts in the gold market can influence how trillions of dollars are distributed across global asset classes. If the current inventory trend evolves into a larger supply squeeze, it could reshape investment flows, central bank policies, and even geopolitical financial relationships. In that sense, the quiet movement of bullion bars in a vault system represents something much larger, a reflection of how nations are positioning themselves in an increasingly uncertain economic environment. At this stage, it is important to remain cautious and analytical. Markets often generate dramatic narratives that ultimately fade as supply and demand rebalance. The decline in COMEX inventories could simply represent routine logistics movements, institutional transfers, or temporary changes in storage preferences. However, if withdrawals continue week after week while prices remain elevated, the situation could evolve into something more structurally significant. The gold market is built on a delicate balance between financial contracts and physical supply. As long as confidence remains high and delivery demand stays limited, the system operates smoothly. But if that balance begins shifting, if more investors decide they want actual metal instead of financial exposure, the structure of the market can change rapidly. History shows that the most important turning points in commodities markets often begin quietly, long before they appear in headlines. A series of inventory withdrawals, a shift in institutional positioning, a subtle change in global demand patterns. Each of these can act as early signals of larger transformations. For investors and analysts, the key is not to assume that a crisis is inevitable, but to watch the data carefully and remain aware of how quickly market structures can evolve. Because sometimes the first indication of a major financial shift is not a price crash or a market panic. Sometimes it begins with something much simpler: gold quietly leaving a vault.